Doing business in and with Europe, tax considerations. Today we have two panelists, Tom Miller, who is a CPA with BKD. Tom has 35 years plus of corporate tax experience, including both in-house experience and public experience with different firms. His specialty at this point is with the International Tax Services Group, and in that role, he advises clients on various international issues, including cross-border transactions, treaty analysis, inbound structuring and planning, foreign tax credit planning, Subpart F analysis, and export incentives. To his left is Mark Roberson, also a CPA. Mark has been with the Simon Property Group for 25 years in various roles, ranging from accounting, finance, and tax, and is currently responsible for real estate investment trust compliance and tax planning. My name is James Motter. I am a clinical assistant professor of taxation at the Kelley School of Business here in Indianapolis. I also come from a corporate tax and international background. I now teach various courses at the university, and I'm very happy to be here and to be able to moderate this panel. So we're going to start out today just discussing some of the outbound tax issues, the life cycle of conducting a business outside the United States. One particular issue there is whether or not you establish a foreign presence that can give rise to higher tax liability. And we're also going to try to address value-added tax issues. That's a major issue in Europe. And we have a whole list of other things we could cover depending on what we get to. Mark's also going to share his experiences at Simon with their investments in Europe. So with that, I will hand it over to Tom.
Thanks, James. Can everybody hear me okay? Yeah, good. Okay, well, as James said, where I thought we would start today would be talking about the life cycle of conducting business outside the U.S. I work with a number of clients. Many of them obviously already have substantial existing operations. But I do presentations talking about the life cycle and the various stages that companies go through. And I've broken that up into various stages, the first being what I call startup activity. And the reason why I start there, and I'm talking about really before they're doing international activity, but just starting the company. And our recent tax legislation has changed this quite a bit. But it used to be that if you were forward thinking, you would, when you were starting your business, you'd be thinking about where you want to put your activity and where you would want to own your intellectual property. IP and IP ownership is key in effective international tax planning. Now, the recent tax legislation has changed that drastically because the game used to be, I guess I would say, was establishing foreign entities, putting earnings offshore, and keeping that profit offshore. And so what you would try to do is put your intellectual property, at least the foreign portion of your intellectual property, offshore. This is very well established and what was very common practice for all of your multinational companies. But tax reform has changed quite a bit of that. But I still think it's very important that at that startup activity stage that you're thinking about where you're going to be going and establish your structure accordingly. Do you agree with that, James?
Absolutely. And even with tax reform, maybe the rules have changed a little bit, but it's still something you should give explicit thought to. Okay, maybe the results of one move versus another are a little different now, but you still have to decide what move to make.
Absolutely. Then I would say, once you've started your business, it's not unusual to start thinking about foreign activity or actually having foreign activity. Usually the first stages is exporting your U.S. goods or services. And that can be done very effectively, and there's incentives in the U.S. code to assist in that manner. There's a couple of them. We'll get into a little bit more in depth on those later. But can you service your clients or customers from the U.S., or do you need to establish a foreign tax presence. That's usually one of the big issues. I'll get into that a little bit more once I walk through some of the other stages. Then usually, once you determine whether or not you need to have a foreign presence or not, you may want to get into producing internationally, establishing factories overseas, or working with contract manufacturers overseas. As we'll talk about a little bit later if we've still got time, is that some of those structures can be extremely elaborate and have very complicated tax results as a part of them. Again, some of the recent changes, both in the US and in other countries, have changed the way companies do business internationally, at least from the tax perspective. Another aspect that people work with quite a bit are establishing holding companies for your jurisdictions. You know, it's one thing if you're going to have one location outside the US, it's something very different if you're going to have multiple entities throughout the globe. Again, tax reform has changed this to some extent, but most companies still use some kind of structure where they would have holding companies and move money around without it necessarily coming back into the US. Repatriation would be sort of the next stage, because that used to be the 800-pound gorilla in the international world. It was companies would create a foreign structure and then make profits offshore, try to keep them offshore, but would not be able to repatriate them back to the US without incurring some US taxation on it. So the game, what James and I have spent many hours on for our clients, is figuring out how they could repatriate tax-free or at the lowest tax cost available.
Or to look for other foreign investment opportunities. Then you can leave the money parked outside and expand your operations there, and then you avoid the repatriation. You put it off, essentially.
But again, tax reform, that's one of the big things that tax reform has changed. And again, we'll talk about that a little bit later. So, and then the final stage of the life cycle was exiting a country. Exiting a country can be very complicated depending on what country it is. Sometimes it's as simple as selling off the assets, liquidating the company, and pulling out. Other times it can be like you're trapped in there and it's difficult to pull out. Various countries, Germany can be one where it is very extensive process to pull out. UK, being the very form-driven country, it can also be quite extensive. France has some issues associated with it too. Those are all three that I work with pretty regularly. And when I try to eliminate a company, it can be an extensive process. I frequently have clients expressing some level of frustration because it can be just administratively burdensome to pull out of a country. So, that being said, anything you want to add to that, James?
So, I agree with everything he said. In general, there's always a tension between business considerations and tax considerations. It may make perfect sense for you to do something from a business point of view, maybe to operate in a foreign country, or to pull out of a foreign country, or to repatriate, or to make a foreign investment. But tax considerations can really skew that. It can prevent you from doing what makes the most sense from a business or economic point of view. So as advisors, what we try to do is help clients get over those hurdles, to navigate the network of rules so that you can achieve the best business and economic result without getting into too much trouble from a tax perspective. And that's essentially what all of international and corporate tax planning is about.
Very good. So let's talk for a minute about, assume that you are in the stage where you want to go to Europe and you're going to create a taxable presence, or you're trying to determine whether or not you need to. I mean, it is permissible to go into the EU and sell. The U.S. has tax treaties with a number, almost all of the countries throughout the EU, if not all of them. And if you have treaty protection, you're generally permitted to conduct business within the country, provided you do not establish a permanent establishment. Now, what is a permanent establishment? And the treaties will generally describe what that can mean. And usually it is establishing an office, a factory, a workshop, construction in progress, something along those lines. Are you permanently there, or are you just conducting your business, coming in, selling, and then leaving? Now, you do need to be a little bit careful if you're conducting the sales activity and doing it pretty regularly and concluding contracts there, because you can create a situation where you would be taxable on that activity in the foreign jurisdiction. So, but generally speaking, if all you're looking to do is to sell into various jurisdictions, you can usually do that without creating a taxable presence. If your good is a tangible product, you can usually establish a warehouse to supply your customers, and just having the supply of goods in a foreign country, provided you're treaty protected, is generally permissible without creating a taxable presence for you. Now, if you're doing business or looking to conduct some business in a treaty or in a country where we do not have a treaty, that creates a whole nother issue. The treaty threshold as a permanent establishment is pretty high, and it's designed that way on purpose to promote international commerce. But where some of those countries where we do not have a treaty, you have to be careful then, because it tends to be a much lower threshold as to whether or not you're going to be taxable under their rules in that country. And surprisingly, there are some major countries, not so much in Europe. As I said, I can't think of one offhand that we don't have a treaty with in Europe. But Brazil is one of the ones that comes to mind. A significant trading partner for the U.S., and we do not have a tax treaty with Brazil. For that matter, most of Latin America we do not have tax treaties with. So you need to be careful when you're conducting business in those countries, because the rules are different in terms of, do I have a taxable presence, and can I do what I'm trying to do without creating a taxable presence? Or do I need to go ahead, bite the bullet, and establish an entity or a branch or some other form where, yes, I am going to be taxable there? Anything to add to that, James?
Again, agree with all of that. One thing that makes this area very interesting is that there are some differences between what we would call international norms, or the OECD standard, and that is an organization based in Europe, the Organization for Economic Cooperation and Development. It's a very old organization. Around World War II is when it was founded. They have their own standards, their own norms, their own sets of sort of model documents, including tax treaties, their criteria for permanent establishment, and then we have our U.S. norms and our U.S. standards for all of those things. For example, in the United States, we don't refer so much to permanent establishment as we refer to something we call a trade or business, a U.S. trade or business. And so the concepts are related, they're very similar in some ways, but there are differences, and so that makes an extra layer of complexity here, because not only do we have to weave through the U.S. standards, but we also then have to add this layer of complexity at the international level and sort of meet both. Fortunately, Treasury has done a lot of work to try to standardize our treaty to the OECD so that we're achieving our goals while also complying with the international norms, but there's still some differences. And with tax reform, we are sort of moving closer to the international norms. I don't think we're quite there yet, but we use a worldwide system, and the rest of the world, for the most part, uses a territorial system. And part of the Reform Act was to move a little bit closer to that territorial system that is more the norm in pretty much every other developed country in the world.
Yeah, let's talk about that a little bit. What I wanted to talk about next is assuming you have decided you're going to be conducting business in a foreign jurisdiction and you are going to be taxable there. The next question is, how do you want to structure that activity? And I think that provides a good segue to chat a little bit about what tax reform has done. Generally speaking, you can structure your activity as a branch. And if you structure it as a branch is the equivalent of a sole proprietorship, wholly owned, not an incorporated entity. So if you establish a branch, say in France, France is going to tax that activity. And then that activity, since you're conducting it as in branch form, is going to be included in your U.S. activity as well. So the U.S. is going to tax that. Now, what that permits, or what the U.S. permits, then is a foreign tax credit to alleviate double taxation on that income. To the extent you're paying tax in France, the U.S. is going to permit a foreign tax credit to eliminate that problem. So a branch is usually the simplest structure. In my experience, I use branches only if they are clearly the best alternative. And part of the reason is that something called transfer pricing. Transfer pricing is when you are conducting business between related parties. So if you think about our branch in France, how much of a profit on that French branch's activity does France get to tax? Because as I just said, the U.S. is going to grant a credit for that. So the U.S. wants France to get as little slice as they can, whereas France is going to be looking at it, and France tends to be one of the most aggressive in the EU, I would say. They're going to try to tax it as much as they can. So we do have a set of rules. It's in the U.S. statutes. It's Section 482. It's one paragraph, and yet hundreds of pages of regulations on the topic, because as you can imagine, it's an extremely complicated area. And James mentioned the OECD. The OECD has their separate guidelines. So most of the European countries, because that tends to be who is in and drives most of the OECD, they follow OECD rules, whereas the US had developed its own set of rules. They're similar, but different. So it's important then that when you have those cross-border activities, you make sure that you're complying both with, in my example, French rules, which are likely to be OECD, and US rules as well. Okay?
Just to flesh out, I used some terminology. I realized I probably shouldn't have used terminology without explaining it, but the rest of the world uses a territorial system, which is based on the attitude that if there's business activity in a particular country, that country has the primary or first opportunity to tax that income. We use a worldwide system where for our citizens and corporations that are established here, no matter where they earn the money, we want a claim to that income. And so that is an inherent conflict because, like he was saying, France is over there saying, hey, you're doing business here, you're generating profits here, you're having sales here, we want to tax that income. But then at the US level, we say, well, you're our corporation, you're our citizen or whatnot, so we also want to tax that. And then it's a competition as to who gets to tax it first and who gets to tax whatever portion the other country doesn't tax, and that's what he was discussing. In France, the tax rates are going to be relatively high. And so by the time you've gone through French taxation, there's not a lot, if anything, for the US to tax. But in a lower tax jurisdiction, and a lot of corporations do seek out these low tax jurisdictions, that's part of the game. You might go and get a tax holiday in Malaysia, for example. I had a client, they struck a deal with the Malaysian government, and they said, we will not tax you for 10 years. So, of course, we moved all the IP over there. All the profits were going to run through Malaysia. And there was going to be no tax for 10 years. But then, to the extent the U.S. can, we want to claim some portion of that income and subject it to U.S. tax. because there's a lot left to tax there.
Okay. All right, so I mentioned you could elect to be or taxed as a branch. As I said, I'm not a big fan of branches, and transfer pricing is part of the reason why, because how much does France get of that? And with a branch, it's a little more nebulous, I think. Or you could set up a corporation in France. You could set up either a French Inc., which is an SA, or France has a couple different types of entities that are similar to our limited liability companies. An SRL and an SAS, I think, is what they go by. And I'll come back to why I mentioned those. But if it's a corporation, the way the rules used to work before tax reform is that tax, or those earnings then, stayed in the foreign company until repatriated as a dividend back to the U.S. So the old rule was that when they were repatriated, the U.S. got to tax it. That was its chance to tax those profits. But they permitted what was known as a deemed paid foreign tax credit on those. So to the extent that foreign subsidiary paid taxes in France, and then it's repatriating to the U.S., then the U.S. would tax all of the income, but permit a credit against the earnings, the taxes that have been paid in the foreign jurisdiction. Now, as James mentioned, France tends to be pretty high, so in that situation, it did not result in a lot of net tax in the U.S. But also, part of the game when we're doing this is, are there low tax jurisdictions? Ireland might be a better example, 12.5% tax rate. With the old corporate rate of 35%, if I paid tax on $100 at 12.5% rate, I've got $87.50. When I brought that back to the U.S., I was going to be taxable on the gross amount of $100, so I'd have $35 tax, less my 12.5 that credit for the taxes I paid to Ireland. Now I've got to pay $22.50 to the U.S. because I brought that money back. That very issue, that was called deferral, meaning you deferred the recognition of the income in foreign jurisdictions. That got to be a huge political football. And I'll tell you that most other countries, most of the other developed countries, didn't have that type of a regime. They've got what they will call a participation exemption, where if you're doing business in a foreign jurisdiction, let's go back to France, having an Irish sub, if Ireland paid a dividend to the French parent company, France granted a participation exemption saying, you were doing business in another country, you paid tax in the foreign country, we're not going to tax that income. So U.S. multinationals were claiming, hey, that is a huge problem for us. And you could look at the balance sheets and the financial statements of any major U.S. public company. I think Apple got to be one of the big ones. They had $269 billion, that was a B, $269 billion of cash in the company. $252 billion of it was offshore for that very reason. If they brought it back to the U.S., they had to pay the tax differential on it, so they didn't want to. So as a result of U.S. multinationals building up all these earnings offshore, and as James said, keeping it offshore, looking for investment opportunities offshore, that's why included in the tax reform, probably the biggest change on the international side in my career was the fact that we have now adopted that participation exemption system. So all those earnings that have been offshore were taxed as of December 31st. You may have seen some of the headlines. Apple, I think, recorded a $38 billion charge for the tax that was going to be imposed. Now, the government did cut them a break, 2 breaks basically. Depending upon what they were invested in, the rate could be a lot lower, 15.5% or 8%, depending upon what they were invested in. Or also, I should say, it could be spread out over 8 years. So don't feel too bad for somebody like Apple having to pay $38 billion. because remember, they had $269 billion on the balance sheet, and they get to pay that 38 interest-free over 8 years. So a good deal for them. So as a result of this change then, the new rule then is we've adopted this participation exemption. So now when you repatriate those earnings from your foreign subs, if you repatriate them to a C corporation, which is what most public companies are, it's not taxable to them. So huge watershed change in the international tax arena. But what I've got to point out is that most people, and because I deal in the middle market quite a bit, middle market companies really didn't get a change. They were conducting business in a pass-through basis, so there was usually only one level of tax, maybe one in the foreign jurisdiction and then one at the individual entity level. And their rules really didn't change very much. They don't get the benefit. So a lot of the impact of this tax reform and this aspect of tax reform was aimed at those major multinational corporations in order to permit them to repatriate those earnings and invest in the U.S.
Mm-hmm. So what Tom is saying is actually very good news, both for business entities but also for the nation as a whole. Historically, the rules encouraged people to leave these earnings overseas and to not bring them back because there was a huge penalty. And that's bad for two reasons. One, it limits the flexibility of our citizens and our corporations from doing what they want with their own money. There's a significant cost. There's an inflexibility between leaving it out of the country and bringing it back. So maybe they'd like to bring it back, but there was a disincentive to do so. And that's bad for the economy because if they can't bring it back, they're not going to invest it here. Jobs aren't going to be created here. They're going to be created overseas. Investment is going to be done overseas. So that's great for other countries, but we were essentially shooting ourselves in the foot with that. And so part of this tax reform was to encourage people to bring the money back, if it made sense to invest it here without tax considerations, to do so, to create the jobs here if that's what made sense. And so fortunately, I think we're starting to see the effects of that. It's going to take a few years before things really fully roll out. But Tom's also
I was going to say let's skip and give Mark a chance to talk a little bit about some of his experiences.
Yeah.
All right. Well, Simon started investing in Europe in the late 1990s. We bought a company over there and used that. I believe it was Luxembourg or Netherlands. I can't remember back that far, but we used that as a vehicle then to go overseas, so to speak, and invested in countries like Poland and Germany, etc. And we, in a lot of cases, would use what we call a joint venture partner. There's people over there that are kind of smaller developers that kind of know the lay of the land, if you will. And that seemed to be pretty beneficial because there's a lot of, and this is kind of getting away from the tax aspect, but there's a lot of nuances when you go into some of these countries. And maybe it's local zoning, all sorts of things come about. So it was very beneficial for us to partner with local developers. Eventually, we exited that investment and then actually bought another company, actually formed with sort of like a Walmart over there called Carrefour, and they were primarily in Italy. So we had 40-some properties in Italy. Again, after 4 or 5 years, we exited that investment. Currently, we have 3 different investments in Europe. One is with a joint venture with MacArthur Glen, who's been involved in Europe for quite a few years. We have 7 or 8 malls across Europe. Then we have an interest of about 21% in something called Klépierre, which is a French SIIC, which is pretty much equivalent to what Simon is, which is a real estate investment trust. And then we have a 10-12% ownership in something called Value Retail PLC. So all those together, over the last 20 years have, I've seen a lot of different ways to invest in Europe. I'm probably coming at this at a little bit different angle than what Tom's just talking about, is that we're not selling, we're actually buying land, developing a mall, etc. And one thing I'll say right now, when you do that, you spend a disproportionate amount of time in relationship to developing a mall over here. It's just, that's what it's going to take. And that's probably going to hold true somewhat to even the stuff Tom's working on. So I'm not going to discourage anyone from investing in Europe. I'm just going to tell you right up front, it's going to take a little more time and effort and cost to get it off the ground. Recently, we established an office in Luxembourg, and it is holding all our investments. We've got people on the ground there, like I believe 6 people. And so we have malls in Japan and Malaysia and Korea. All that ownership is filtering through there. And it goes back to a little bit what we were talking about of participation exemptions, et cetera. Actually, there was some, I believe both the Netherlands and Luxembourg were kind of attacking, saying, hey, if you don't really have a presence here, we're not going to honor some of this participation exemption. So that's kind of why we did that, and in a lot of cases, it's probably going to be better for us in that we have one group over there that's monitoring all our international investments. There's a couple items that come to mind just up front. I think there's this belief that real estate wouldn't pay any income tax in these countries. That's not true. When we do our pro formas that we're going to invest in this country, we've got a tax cost in most cases. And I think I read this about Italy. It kind of gives me a little pause. I think if you have an uncertain tax position in Italy, they can hold the officers of that entity criminally liable. So, tread lightly there, I guess, is my advice. And, always when we invest somewhere, we want to know what the exit strategy. That is, that's probably the first thing out of our executive's mouth is, how are we going to get out of this? Somewhere down the road, we want to sell this property. How are we going to get out? And is there a toll charge, so to speak? We've done a pretty good job of minimizing what that toll charge will be, but that's the first thing out of their mouth. So that's kind of been it for Simon over the last 20 years in Europe.
Yeah, Mark, a couple things that you mentioned there. I didn't touch on it, but taxation of real estate. If you're looking to go overseas and you establish a foreign entity to own your operations there, if that entity owns real estate, and then you maybe, or when you're exiting, if you're going to sell the shares of that company, because in the U.S., the general rule is if a foreigner sells shares in a U.S. company, they're not taxable on that. But most countries are very sensitive when it comes to real estate. And so even if you're selling shares in a company, but it owns real estate, then they will tax that company. The U.S. does it too. It's just a way to kind of protect the U.S. tax base. Some countries, I think it's Belgium, does not do that. So if you ever look to buy property in Belgium, you're likely to pay, say, $1 million for a building, but you won't be buying the building. You'll be buying the shares of stock of the company that owns the building, and your basis in that building will be 10,000 euro or something like that, because Belgium is one that doesn't do that. But yeah, so when you were talking about that, that's what I was thinking, is just the fact that the real estate taxation is a little bit different than the treatment of widgets. That, and then the second thing was the holding companies. I had mentioned holding companies in terms of a consideration. Mark mentioned the Netherlands and Luxembourg. Those are your usual suspects when it comes to a European holding company. They were great jurisdictions. They had a good treaty with the U.S. And so you were able to do certain things throughout Europe and then transfer the funds to the Netherlands or Luxembourg and then repatriate it back to the U.S. Remember I said early on the repatriation issue was part of what we spend all of our time doing? Well, that's part of the benefit of a holding company. It also permitted you to maybe reallocate, pull money out of France, put it in the Netherlands, and then go reinvest in Germany.
Yeah, I mean, historically, we've tried to keep the cash over there. It just made more sense to us, and I won't get into all the REIT issues, et cetera, but when we started bringing that back, it increased our distribution requirements, et cetera. You know, on the was it Code Section 965, the whole repatriation here. I was on a panel earlier this year, and most of the REITs were bringing, they were treating it all in 1 year. They weren't availing themselves to the eight year, which was a little surprising to me, but and we have our reasons. We're spreading it out over the 8 years. We're not bringing it all back at once.
So just to add to what they've been saying, as Tom said, there are differences in the rules between taxation of manufacture and sales of widgets overseas and real estate. I alluded earlier to this conflict between foreign claims on income and U.S. claims on income, and there's perhaps no area where that conflict is more heated than real estate. It's just because no country likes the idea of another country taxing its own dirt more than it would, right? If they're going to tax anything in their country, they're going to tax their dirt and the buildings that stand on it. That's their first primary focus. They might be able to let go of some other things, but that's where they're going to be most focused on. And that leads to a bit of a larger point, which is we've discussed a lot of the general points, and Mark's given us some experiences in a particular industry. There are other special industries where you might encounter special rules. In my classes, I focus mostly on general rules, but I always tell my students real estate, farming or agriculture, banking, insurance, these are some of the big industries where for the unique considerations of the industry, every country will have a special set of rules, both in terms of the commercial law but also the tax. So if you're in a special industry, not only are you going to need to get some general tax advice, but also maybe a specialist in that area can help you navigate the specific concerns. Where do, I don't know where we want to turn at this point. We still have VAT to talk about. VAT is a very huge issue in Europe. We don't do this here. There's been a lot of talk, but it just hasn't ever gotten political traction. But if you do any business in Europe, you're going to have to manage your VAT liability.
Absolutely. And VAT, I think, is probably one of the most misunderstood issues. I get lots of calls from my entrepreneurial clients where they haven't followed the rules and now they've got a problem. They've paid VAT and they're trying to get it back. And it can just lead to a tremendous amount of confusion. VAT, for those of you that are not familiar with it, is somewhat similar to our sales tax. And I say somewhat because there are huge differences in it. VAT is imposed at every step of the business cycle. So if there's a mining company and they're pulling ore out of the ground and then they sell it to a refining company, they'll sell it for 100, and if VAT is 15%, they're going to collect 115 from that company. And then the refining company, the mining company then will remit that 15 to the government. The refining company will process it and then sell it for 200. And when they sell it to this steel company, they're going to collect 230. Now they they have collected 30 of VAT, they paid 15 of VAT, so they're only going to remit 15 to the government. So the mining company is okay, they're not out of pocket. The refining company is okay, they're not out of pocket either. The steel company then creates the product, and let's just cut it short and say then they sell it to the consumer for $300. They're going to collect $300 from the consumer, and the consumer is going to, I'm sorry, $345. They're going to sell it to the consumer for $300. The consumer is going to pay $345, and that's where the cycle ends. The consumer winds up paying it. It's a tax on the consumption of goods and services. Now, where problems come in is where, I'm going to change my facts a little bit from that simple one, and let's say the refining company paid 15, and for various reasons, they only collected 10 from the steel company. They've got a $5 refund coming. Now, in Europe, it's pretty clear that you should be able to get that refund, and I haven't heard tremendous issues out of Northern Europe and Western Europe of getting that refund. Sometimes Southern Europe, that's where a lot of your financial crises were. It might take you years to collect that money. It's not relevant to Europe, but Mexico was having some problems there too. And Mexico was having a hard time staying current in issuing those VAT refunds. I mentioned Brazil before. They're probably the poster child for refunds that you may never get. It is a tax that is, I think, in concept, a much more efficient tax than income because it's on a business transaction, and every transaction is taxed. And it's much easier to tax that than it is the concept of income. I mean, think about all of the things that go into the determination of income. Sure, it's easy to decide whether or not you've got a sale, easy enough to figure out what your cost of goods are. But when you start getting into deferred compensation, as an example, when do you get your deduction? When don't, we've got tremendous rules on something like that. The definition of income can be complicated, whereas the gross receipts on a transaction, whether it's a good or a service, is quite simple. I personally am somewhat of a fan of a VAT, but in our current political system, we've got one party that views it as a regressive tax, because it's likely that if you do impose a VAT, your lower income people would be paying a higher share of their income in taxes. And then you've got another party that views it as a machine, a potential machine to crank up taxes and impose more taxes on the population, and so they don't like it. But I think if we ever get to the point where one party views it as a tax on the lower income who don't tend to vote for them anyway, and the other party views it as a source of revenue that they can crank up, I think then we might adopt a VAT. Now, we didn't have a participation exemption until this past year, so who knows? It might be that we could sometime get a VAT. But as I mentioned when I started, I get a lot of questions. There's a lot of confusion over it. It tends to be a somewhat technical area, not as complicated, I don't think, as our sales and use taxes. Because remember, our sales and use taxes are imposed by each state. So you got 50 sets of rules you got to deal with. Generally speaking, most of Europe deals with it with their own country has their own rules, but they tend to follow the OECD's guidelines. So most of the general rules tend to be pretty consistent throughout Europe. But it is a tax that confounds Americans, I'll tell you that.
Mark, have you encountered VAT issues with your real estate investments?
Yeah, a little bit. It's, I think exactly what Tom said here. It's, you kind of struggle with it initially, and I agree, conceptually, it should be fairly simple. Sometimes, though, I don't know if it's a language barrier or just, interpreting what the rules are, you run afoul a little bit. So we have experienced it a little bit, but we're not typically selling anything, so it's not a big issue for us.
Okay. There's also, I guess, differences between the routine collection of VAT. You go to the grocery store, you're going to pay VAT. And transactional collection. If there's a large sale, maybe a sale of property or a sale of a business or sale of a subsidiary or some sort of a business line, there are going to be VAT issues. I actually, before I came to teaching, one of my last large client engagements, we spent maybe 9 months mostly focused on VAT issues. We had to interact with attorneys from other countries on what those VAT liabilities would be. We were the buyer. We were trying to buy a company from another corporation, and we came up with what we thought we should have to pay for VAT. Okay, we spent a lot of time on that. The seller also came up with what they thought they should collect. Now, at the end of the day, the buyer, the exec said, yeah, there was a difference there, and the execs basically said, thank you for 3 months of work, but we actually don't want to pay any VAT. So we appreciate the estimates of what your reasonable liability is, but we're just going to put zeros in that spreadsheet. And that became a bit of a contentious point for the seller because, and this is an important point, this is my main point, as a seller, you have an obligation to collect that VAT. And if you do not collect the VAT, you become liable for it. And so there's a tendency for buyers to not want to pay it and for sellers to want to over-collect. And that means in any sort of deal like that, you've got to sort of negotiate the middle point. At the end of the day, they sort of elevated it to the execs, and they worked it out from a business point of view, took it out of the hands of the tax people, which is fine with me because I didn't want to deal with it anymore. But it is something to consider. Do we want to take some questions now? I don't know if anybody in the audience has questions or any specific issues that interest you. There's, I guess, a microphone here if you want to just proceed to the microphone.
Yeah. No.
Tom, you'd go to Tom.
Well, that is exactly right. If you're going to be investing funds, and Mark can talk about this because he's got direct experience with it. If you're going to be investing in a foreign jurisdiction, you're going to be acquiring a subsidiary, you're going to be investing in a factory or business operations there. Yes, I think it behooves you to understand what happens. If you're wildly successful, of course that's the easy one, and everybody wants to talk about that, But what also will happen to you if you're not successful, and how are you going to get the money out back to the U.S. If you exit? And what are the taxes going to be on it? I'm working with a client right now. Now, this particular one isn't Europe. This is Asian, but they invested a tremendous amount of money and in various joint ventures, and they weren't thinking down the road of what happens when they pull out. Some of their JVs have been very successful, some not so much, and they're getting absolutely crushed on the taxes because that foreign jurisdiction is taxing them, and then the U.S. is going to tax it as well, and that's on top of the taxes that they paid on the profits where they had them. So I mean, it was just it's kind of a tough situation. Fortunately, they've done well enough overall that all it's doing is reducing their very favorable return overall. But so who you go to is me, because I work with Ed, James, I'm sure, but more importantly, make sure that we are working with the people in the country, the local country where you're going to be investing. Okay, Mark, do you got anything to add to that?
No, I think that's good advice. A lot of times when we go into a country, we seek out local counsel there to help us through that matter. And so we've got about 3 or 4 sets of eyes because, our auditors are looking at it, our legal counsel in the U.S. is looking at it, and then you have this other party in a country that's looking at it. So there's a lot of moving parts there, and at the end of the day, we want to be getting that cash back with minimal withholding or tax.
I'd also say we could answer this question really in 2 ways, and we've answered it in one way, in the sense of who do you go to for professional advice? So somebody like Tom with extensive experience could give you advice. I'd also answer it a different way, which is Mark's company has done extensive investment. So if you're new to this, maybe you don't want to wade into this area alone. Maybe it makes sense for your first investment to look for a business partner, to look for a joint venture partner, somebody that you can share risk with and reward. They may have more know-how, they may have more experience, they may know contacts in the local area, both from a legal and an accounting and a compliance point of view. And then that way you kind of have somebody to hold your hand and help you along, and then you learn without having to make all the mistakes yourself.
It's one of the things that I had in my notes here, and we just didn't get into it. But yeah, in my group, we refer to our group as the International Tax Services Group. And we refer to ourselves as a 3-legged stool. There's core international, which is what I do. I typically work with businesses and focus on their business taxes in the U.S. and foreign jurisdictions. And then I mentioned transfer pricing, because when you're doing business or have transactions between related parties, at least 2 governments have a vested interest in at what price they're doing that business. So transfer pricing is its own specialty within the international tax world. The 3rd leg of that stool is expatriate taxation. And for U.S. individuals living and working outside the U.S., there's special rules associated with it. And then there's special rules, usually in most foreign jurisdictions as well, when a foreigner is living and working in their country. So what we have is a group of individuals who focus just on those matters. To give you an example, though, most companies, when they put somebody overseas, they find 2 things. One is that it is extremely expensive, not so much from an administrative perspective, but because of point number 2, and that is the individuals are usually subject to taxation at a much, much higher rate, because in most of Europe, individual tax rates are considerably higher than they are in the U.S. So most companies, when they do that, when they move somebody who's earning $100 here and subject to $20 of tax, $80 after tax, now they're going to go to France and they're going to be taxed at $40. So how do we get them back to 80? Well, we've got to pay them another 20. Well, wait a minute, that 20 is now also going to be taxed. You're going to lose $8 of it, so you have to gross it up. And the beneficiary of that is the foreign government. You're trying to keep the individual whole. Now, there are some companies that don't adopt that policy, but I think you'll find that most Fortune 500 types of companies make people whole when they do that. James, did you?
I was going to say, by the end, you're up to 133
Exactly.
to get them back to $80 essentially. Mm-hmm. So that's a significant premium over what you're paying them in the U.S.
Exactly. And then there's also Social Security taxes. If you are a U.S. citizen and going to be relying on Social Security at some future point, you're going to continue paying it. And most other countries have their form of Social Security, so you can get a waiver out of it so that you're not paying that in the foreign jurisdiction.
Right.
Anything else to add?
Although there are people, especially on the U.S.-Canadian border, people that for an entire career perhaps, live in the US but work in Canada or vice versa. And then you have, for a career basis, a pension issue. If they've got a foreign pension but then they retire to their home country, how do you handle that? So there's a whole set of rules on that as well. I guess I would just add, you've summarized pretty much, there's inbound and outbound taxation. Okay, we've focused mostly on outbound issues because we're talking about corporations and individuals doing business abroad. That was your primary question. What if we send our workforce abroad? General rule is you can send people abroad and they can make up to about $100,000. They change the amount every year, but it's a little over $100,000 now. And you can provide them with housing allowances, and that becomes exempt from U.S. tax. It's only subject to the foreign tax. But then you've got the issue that Tom was talking about, where you've got to pay them a bit more than you would have been paying them here because of the higher tax rates. On inbound assignments, where we bring somebody from a foreign country here, there's a whole different set of rules. But essentially, they're taxed as if they're U.S. citizens, just like a foreign country would tax our citizens going abroad.
Yeah, there are some other rules too that you may need to dance around. If an individual is spending a lot of time in a foreign jurisdiction, you may need to look to the treaty to see whether or not they're going to be taxable. Canada is one, and I at our conferences I tend to give the Canadians a really hard time about this, because they have a policy where if you go into Canada and you're working in Canada, and if you make, I think it's more than $10,000, 10,000 Canadian, you are taxable in Canada on that. So they're going to withhold, you're supposed to withhold Canadian tax. Now, you can turn around and either, you may be able to get a refund of that, but you're going to have to file a Canadian tax return, or you can claim a foreign tax credit for it in the United States. But either way, from my perspective, I used to get more upset about Canada imposing the withholding when they were going to turn around and force you to file a return and get it refunded. They also have a similar rule on corporations. If corporations are sending people in to do service work in Canada, the rule was that a Canadian business paying the U.S. company had to withhold 15%. Even though, remember I talked about a PE, you might not have a permanent establishment in Canada. Therefore, what the company has to do then is file a return, claim that refund, but they're out the money for 18 months or up to 18 months. Very, not very neighborly is what I always thought.
So unfortunately, I think we're out of time, but I want to thank Tom and Mark for participating. I want to thank Indiana University CIBER for hosting this event, and thank all of you for coming.